Hey, good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, January 26th, and we're going to jump into it because we do got a bit of economic news releases scheduled for today and a lot to go over. So we're going to jump right into it. And first item to note will be the weekly jobless claims that we have. The week before, we had 356,000 people applying for unemployment. They figured the number would jump to 373, and it basically met that and a little bit more regards to the forecast. So unemployment, basically more people applied for unemployment last week. And next item to note will be durable goods orders for December. So back in November, it was up 3.7%, which is a pretty decent number. They figured it would drop down to 2.4%. For December to kind of close out the year, but actually it slowed down a little bit, but it did. It was still up, so it's better than the forecast at 3%. So that's good to see. Next item to note is the leading indicators. Basically, this is a gauge of 10 different industries as to where the kind of help us see where the economy is moving and how they're all affected as a whole. So basically, back in November, it was up 0.2%. It figured to jump up to 0.9%. Although it did go up from November 0.4%, but not to what they forecasted. So, it's still a decent number. It's but from 0.2 to 0.9, it's obviously a pretty big increase. So, but 0.4 is still a pretty decent number, and we'll take it and hopefully see that improve a little bit further down the road here. Next item to note is new home sales. Back in November, we had 314,000 homes sold, or new home sales. We figured it would increase to 325 and actually dropped to 307. So not as good a news on the new home sales on that way. So unfortunately, that's we'd like to see housing pick up, but from my standpoint, being a mortgage planner, I am seeing a lot of uptick since in January here that we're seeing a lot of offers being sent out there, seeing a lot of people jumping into the market right now. So it's getting pretty busy from a purchase standpoint of things. So, and of course, purchase refinances are also kind of picking up as well, especially those getting ready for the HARP 2.0. If you haven't done so, I would highly recommend doing so sooner, because as the supply, even the bonds improve a little bit, lenders may hold back on the pricing a little bit, primarily because of the supply demand. They want to try to slow it down a little bit, so they'll keep the rates a little bit higher just to slow down the process as they try to catch up. So keep that in mind if you're looking to refinance or even purchases, why the rates aren't improving as much as you may think they might. Okay, so with that said, we'll jump over to the headline news here today. And basically, kind of like yesterday, the stock market's kind of mixed today. The Dow is up a little bit, where the other markets were down a little bit. Not heavy trading right now. And then another item was headline news was Greece may receive a lower rate from their private investors. The investors who have been buying their debt, so they may do a swap where exchange for basically a new program where they'll basically lower their interest rate. And I think right now they're kind of looking at about 3.75%. So we'll see if that comes to fruition, if they're able to get that cleared away so they can get their bailout in March. This will definitely be something to be watching at, as see where things are kind of move forward. And also, like yesterday, we did mention Portugal to keep an eye as their costs have been increased, so they may need something similar to what's going on with Greece. Now, for the Fed statements yesterday, we'll just go with the highlights here. Primarily, the Fed basically said that they're going to keep low interest rates probably till end of 2014 now versus middle of 2013. Originally, they said back around 6 months ago they're going to keep it low to mid 2013. Now it looks like they're going to say end of 2014, so another year and a half longer than they originally anticipated. Also, there's talk that they may also increase the buying of the bonds, so this may artificially keep the interest rates, long-term rates lower still. But that still hasn't been, they haven't definitively said yes, they're going to do it, but that's on the table right now as we speak. So those two are kind of the big highlights from what we kind of talk about here. So we'll kind of jump over to the bond market and see where interest rates are at today. As we can see, we had a huge day yesterday. We actually were touching the new ceiling up there, about the 103, 103.45, and pulled back quite a bit down to 103, basically 103 level. So we had almost a 100-day swing and pulled back about 50. So we were had a pretty wild day today, and then today we jumped up quite a bit. So it's not really an opening gap as we had that wick, that long wick there. So we are touching the ceiling again. We are kind of pushing it. We're up about 12 basis points now. So we're up, of course, about almost 40, about 30, 38 basis points from where we left off yesterday. So obviously, to say the trend for rates worsening, it looks like it's going the opposite direction, as well as the what's going on with the which we got the, it looks like rates are improving right now. Now, keep in mind, you may not have seen these, but there's what they call G fees at the government. It's kind of basically the government is taxing those who are getting new mortgages, primarily to feed the payroll taxes. You may have heard that they extended it for about 2 weeks, end of the year. So what they did to offset those costs was basically they're going to tax people getting no mortgages. How are they doing this? We're not going to see it, but it's going to be into the interest rate. So a few weeks ago, when we were looking at interest rates going, showed some improvement. Actually, it wasn't improving primarily because they basically put in the averages I've been hearing is about 0.45% to 0.8% in the basis point. So basically, it's like paying almost half to almost a point to get that rate that that you would have had, paying a point to get that normal rate that you would not have been paying it. So it would be basically paying a point for a no point type of loan in this scenario. So to kind of give you an idea of how that is playing out. So they've already built those into the interest rates. We don't see the price adjustments as we would for property or these other variables. So it's already built into the rate. So you may want to know that going forward. And as I said earlier, also if you're looking to refinance or whatnot, I would hurry up and try to get your loan in now as people are gearing up, and they can probably keep rates a little bit higher where they probably should be, just to slow the process down as they get kind of overloaded with new loan applications, as it is picking up quite a bit. So know this, that interest rates are better today, and you guys have a wonderful day. Catch you tomorrow. Sorry for the long drawn out, as we had a lot to talk about today. Have a good day.